Welcome everyone to another installment of Coffee with Carl. Today we have Clay Ogden with Captive Consultants. Welcome, Clay.
Thanks, sir. How are you?
I'm doing wonderful. Appreciate joining us. Today we're going to dive into the world of captives. So with that, I want to turn it over to Clay. Clay, would you mind just tell us a little bit about who you are, what your firm does, and how you guys have helped business owners?
Yeah, I've been in the space for about 12 years now, and used to do business development sales for actually a captive manager.
Mhm.
Uh, Branched off, started our own consulting firm to be able to talk to clients about more than just 831Bs or micro captives. So we specialize in bringing these types of strategies to advisors, CPAs, and business owners, and helping them recognize where it might fit for them, helping them identify the risks that they are currently carrying on their balance sheet that they are not insuring for, and trying to find a more efficient way of handling that.
For those listeners that have never heard about a captive before, maybe you can go into for a couple minutes just explaining what a captive is, and then more specifically what a micro captive is.
Yeah, so captives in general, I think, are becoming more and more known as far as work comp, GL, commercial auto, property, the traditional lines of insurance. And
Yep.
those they work amazingly well if the premiums are, 200, 250,000 and up
Mhm.
for a given business. Claims ratios are fairly reasonable. Those are absolutely things that we should explore for clients, see if it makes sense. Micro captives are more along the lines of helping a business insure the uncommon, unforeseen, the uninsured risks in the business. So things that business owners are coming out of pocket for, or they're just eating the cost of now that fall outside of the scope of their traditional lines. And instead of just, taking the hit year after year, being able to take excess revenues, excess cash flows, park those dollars aside to now insure for those, those more uncommon, less frequent types of risks. But when they happen, they're impactful. I think that building a reserve for that rainy day is really what these are for.
Yeah, that's probably a good transition. I know you shared with me coming in some of those types of risk. I'll go ahead and put this slide up for the viewers, but if you wouldn't mind just going into a little detail
Sure.
into a few of these and the purpose.
Yeah, yeah, absolutely. So audit assurance is something that really applies to most every client, right? Any type of an audit, whether it's a government agency, work comp audit, general business audit, that kind of stuff, and the costs that are associated with that. Brand and reputation damages in the world of today's social media. It doesn't take a lot for someone to say something, do something, maybe misunderstood, taken out of context, whatever. Oftentimes it doesn't matter. Once it's posted, the damage cannot, is done. It kind of runs out of your control in some
Yep.
situations. Um, Business interruption is oftentimes an event that happens outside of your control that impacts the cash flow of the business. Kind of going back to, COVID 2020, 2021, all of those situations, very, very real and impactful to businesses. Mechanical breakdown is actually a newer policy for any kind of a business that has equipment. If it goes down and it causes a disruption to the cash flow of the business, or repairs or anything like that, that's absolutely something that's pretty meaningful to a business. Um, Business credit default is really for the accounts receivable of a business. So if you've got, outstanding AR, some business owners, they don't operate on with AR, others do. And if you're able to set aside a portion of your funds or a portion of your excess gross revenues to pull those funds back into the business if and when, someone maybe goes insolvent, or leaves you high and dry and you're left holding the bag on 100,000, $500,000 of product that you've already sent out, you don't get paid on. That can be pretty damaging to a business. I mean, there's lots of different
Yeah.
coverages that we can walk through. livestock death loss is something for, folks in the agriculture space, whether it's cattle or hogs or whatever it might be. They have a bad batch of feed, a storm, a freeze. Maybe they lose, you know, 20, 30, 40, 100 different animals. And if those are females, they no longer have the ability to breed them. Um, Again, those things are just things that business owners have been accustomed to eating the cost of and just chalk it up to the cost of doing business. And if there's a more efficient way of managing these risks, that's really what these programs are for.
So, and to dive into that, if you're going out and getting a traditional corporate commercial insurance policy, they're covering, walk through maybe what those general risks that they're covering versus the differentiation here, which these seem to be a little more granular. That might be help to go at a high level for folks.
Yeah, I mean, traditional lines of insurance do a really good job as far as paying a premium for a much larger um, limit of liability.
Yeah.
These types of policies are to cover the things that the traditional lines are continuing to carve out. They're excluding the policies keep getting bigger, but premiums maybe even keep going up, but they're not covering more and more and more risks. And so it falls to the business owner to figure out how to deal with that. And most business owners just assume there isn't a way to deal with it. So we'll just, if something happens, when it happens, we'll just hope for the best and hope we have cash flow at that point in time. I would say the savvier business owners are, preparing for those situations, taking excess cash flow in good years, setting it aside, having these policies in place, being able to file claims and pull funds back into the business to kind of level that cash flow on an annual basis if and when things come up.
What type of, maybe we talked about this on the micro level, what type of size businesses would be looking at these policies? I know obviously everyone can, but in the micro market, what size businesses are involved?
I would say a business that's doing on the smaller side, 2 million gross revenue, being able to set aside a minimum of about 200,000 in premiums into the captive on an annual year. We have clients that are 50, 70, 100, a couple 100 million. But I would say that the bulk of the clientele that would be kind of ideal for this would be in that 5 to 50 million range, where they have excess cash flow. They're a little bit more predictable on their cash flow and what they can set aside to kind of help mitigate their potential risks.
What's how many types of policies do you see, a lot of these companies insuring for? Is there a certain number that they have to do? Walk us through, maybe more on the level of construction.
Yeah, it varies. I mean, some clients will have 5 to 7 policies. Some clients will have 10 to 12 different policies. And so depending on how much premium is going in, kind of helps drive the allocation. Obviously the business, the industry, the underwriting. Some businesses have a warranty or a service contract,
Mhm.
and that's a great way to set funds aside for their potential warranty or service contract claims. Um, it really depends. I mean, every client is unique. Every situation is different. On the construction side of things, contractors specifically, if you scroll down one more page, I believe there's some other policies here that are a little bit more applicable to more contracting stuff. And some of these halo policies are kind of a in addition to the work comp, the GL, the property, those traditional lines. And if something falls outside of the scope of those policies, these policies can be utilized and leaned on. If we go back up to where we're looking at dispute resolution is every year, maybe the most utilized policy. Legal action brought against the business, um, and the damages that are done by that, or the legal expenses that are incurred because of that. Uh, Another pretty critical one, especially over the last 6 years, has been political risk. Whether it's been the pandemic, whether it's been tariffs, political decisions have impacted a lot of businesses. Some really a good thing. Some have felt the impacts pretty dramatically. Um, we have clients that, import a lot of products and they've had a 10, 15, 20% decrease in their profit margin. Some are passing that on to clients while others are just eating the cost of it and trying to figure out the best way to handle it.
Why don't you go through the overall flow and structure of setting up one of these plans? I know you provided a chart here as well.
Yeah. Yeah. So if you look on the far left here, you've got the client's business or businesses. They send the premiums over here to a direct writing, a frontline insurance company.
Mhm.
They retain any fees that they charge there, and then the funds are then passed to the client's captive that's set up in this process. The risk pools, so each of those policies that we just walked through, they represent a risk pool. So if it's siloed out, every single policy is its own risk pool. So you've got dispute resolution as its own pool. You've got accounts receivable that's actually going to be up here in this self-pooled risk pool, right? My AR is not going to be mixed with your accounts receivable. But my political risk policy is going to be pooled with others that have a political risk policy. So it kind of depends on the risk on what type of how we're pooling or building that risk pool. And then a
How
lot of
many
the
groups would
time,
flow into that?
say that again. I'm sorry.
How many groups may flow into that? I imagine each has a different number, but is
Yeah.
there kind of ballpark?
Yeah. I mean, every policy ranges in size or every risk pool ranges in size from probably 250 to 750 insureds, which is very important to where the risk pool is going to share in claims unaffiliated to themselves. And so that's an element of these programs that absolutely has to exist in order to use the distribution of risk um, requirements in insurance. But there's kind of a double-edged sword there, right? More insureds in a risk pool means that there's more likely going to be claims,
Yeah.
while it's also diluting everyone's pro rata share. So it makes my share, your share, everyone's participation in those claims much smaller.
Yeah, so on a baseline, I think when folks go into this, it's very important to realize you could very well be paying cost of others as a part of your risk pool.
I wouldn't even say could be. You absolutely will. It just depends on, at what level.
Mhm.
And over the last, I would say 13, 14 years, it's been pretty doggone managed. We kind of know what those numbers are, what to expect, especially based on the size of these risk pools. But those are awesome conversations to have with clients when we're talking through what this looks like for them, their various policies that they could have, premiums that they're potentially looking at, that kind of stuff.
And then, on that end, is there, based on some of your experiences, so they're going to pay so walk us through at the high level. So they pay in the premium, roughly maybe 10%, 20%, whatever. What is that number of on the premium side? Is there a good ballpark there? And then walk us through what that experiences looks like. Is it maybe they might assume like 5% towards the overall cost for risk, and then walk us through maybe what some of these different things cost, just at a high level, so folks can have a better understanding.
Yeah, absolutely. So as far as costs of the program, $6,000 to set up a captive, and
Mhm.
then the annual maintenance fee each calendar year. That covers re-registration of the entity, tax returns, annual filings, that kind of stuff.
Yeah.
Claims handling. When it comes to premiums that are going in, there's a different fee schedule that's based on the amount of premiums contributed, and that'll range as a percentage that's retained from those premiums that are paid in. And that'll range anywhere from 10% down to 3%. And we can walk through those different breakpoints with clients for um, take a look at what that might look like for them.
Yeah.
We can typically see up to about 10 to 15% of gross revenues that are usually doable and or allowed into these programs on an annual basis. So the revenues increase in a given year, obviously the amount that they can set in potentially increases. As the cash flow or the revenues drop, then the opposite is true. Um, when we start looking at different policies, different allocation, a lot of it's going to be driven by gross revenues, industry, kind of. It's fun to have those conversations, ask questions. A lot of the times, business owners they don't know what this is, or they don't know what questions to ask. We've done this enough times. We kind of know what questions to ask up front, regardless of the client. And then you can see the wheels start turning and, oh, okay, yeah, we have that risk and we haven't really ever thought of it.
Well,
So,
that's why you're here. And, I think for the viewers, it's important to realize that this is a nuanced space. So you want to make sure you have the right experts, and that's why we've been partnered with Clay and his team on on this side of the house. Um, I know one of the biggest things that everyone runs around talking about when it comes to the captive space are some of the tax benefits. So,
sure.
love you to spend some time just walking us through, how that plays into this equation and the big benefits that a company could potentially have on that side.
Yeah, I mean, when premiums are contributed, they're usually going to be deductible in the year that they're contributed to the captive. Um, as far as when dollars go into the captive, they can be in a bank account, they can be invested. Um, Oftentimes, it has to be in liquid type investments, accessible in case claims were to take place. And then we got to make sure that they're in, kind of diversifying those investments. No illiquid long-term types of investments to where if something came up, those types of investments can be looked at in year 2, 3, or 4 when those dollars are earned out or no longer at risk of a claim. Because the policies are going to go into place just like normal insurance policies where they're 12 months.
Yep.
So at the end of that policy period, those dollars become surplus or earned out. New premiums coming in would then follow that 12-month at risk cycle. Um, Absolutely beneficial to, invest as an insurance company would, prudent liquid type investments. And then
Right.
when the funds expire, so if we have surplus dollars, policies expire, dollars are now earned out or surplus. Clients do have the ability to take distributions out of the captive. It's always going to be distributed back to the clients as the owners as a long-term capital gain dividend distribution. So there's some benefit there. There's some arbitrage there. Um, all while the most important thing, obviously, and is making sure that we're setting these dollars aside to cover the business's risks if and when things were to come up. If they don't need them, if they don't come up, great. That's what insurance is. It's there if and when we need it. And the the best, most savvy business owners are they're utilizing these types of programs, being able to build those reserves for the what if scenario.
So the dollars that they're contributing, they're going to get a tax deduction. And then within the program, those surplus dollars, those are going to grow tax deferred.
The only thing that's going to be taxable to the captive is realized investment gains.
Hmm.
So if a position is bought and held, there's obviously no gains that have been realized. Once there is a realized position that's liquidated, then there would be taxable income to the captive, which would be at the corporate tax rates of the current 21%.
Yeah, so I mean that's a pretty huge benefit because you're able to invest dollars within the captive, it grow tax deferred, and then you're paying corporate tax rates on the back end. So huge benefit for the folks. And now obviously this isn't the biggest reason for going into these plans. It's more they have the added insurance coverage, but it's certainly an extra benefit.
For sure. Yeah.
What, for folks that are considering this, evaluating some of the tax benefits, et cetera, as well as the coverage, any other things they should be thinking about? Or, maybe also highlight some other successes that you guys have had with some companies?
Yeah, I mean, we've seen business owners be able to, file claims, like I said, for tariff impacts. We've had clients that have had key employees go down with critical illnesses and or accidents. They've been out for an extended period of time. They've had to find someone to replace that individual for a while, and that can be pretty meaningful for a business. If they've got reserves, they can file a claim and they can use those captive dollars to then help facilitate that in a time of need. Business interruption, we've seen we've seen a lot of claims, a lot of business owners use these in a time of need. And I think a lot of the times people look at this either as I'm never going to have claims, doing this strictly as an arbitrage benefit. And that hopefully, no, every insurance company hopes to collect premiums and not need to pay it out.
Yeah.
But we have seen these benefit clients many, many times over to where it would be a pretty disheartening feeling to know that something's come up. We don't have the cash at the moment. We don't know what we're going to do. We don't know how we're going to keep employees or keep the doors open. But when you've got the reserves built up and you can lean on this as a kind of a backstop in a time of need, a lot of business owners just simply tell us they sleep better at night knowing that if the worst of the worst happens, or even some amount of that happens, I know we're good because we've planned for it.
Yeah, and as we finish up, one of the questions I get is these type of captives have gotten a bad name.
Mhm.
Some of the regulatory agencies. Maybe walk through what some of the challenges maybe that you've seen or challenged structures you've seen, and how you guys obviously take more of an insurance first approach, but walk through what that differentiation is when structuring these things maybe correctly versus incorrectly, and then falling into the eyes of the government.
Yeah, great question. I think there's a lot of abuses that have gone on. I mean, most things there's usually a right and or a wrong way to do it. In these particular programs, a lot of businesses for the better part of 20 or 30 years kind of abused the how much they were putting in relation to gross revenues, overfunding it, maybe never filing claims or filing claims to look like they had claims that weren't a business claim. They weren't a business need. They didn't fit under the policies. They were accommodating things inappropriately, um, taking the funds out, buying permanent life insurance within the captive. Um, I mean, there's some kind of red flags that are pretty obvious, common sense type things. But when you're using these programs and you're setting dollars aside within reason of gross revenues, preparing for potential risks, you have actual policies. There's it's not uncommon for a client to file a claim and it might be denied. And that's just simply because they didn't have that coverage, or maybe it falls outside of the scope of that policy. Um, just because we're setting dollars aside, it's not necessarily a catch-all for everything. It is insurance, so we got to be setting dollars aside for various meaningful things, not just a net to catch anything and everything we want. Um, I think those are some of the big things that really kind of come down to the important details of what you're doing, why you're doing it. There's still some folks out there that they don't like being able to, being told exactly what they can or cannot do, and that's okay. It's not for everyone. Truthfully, it's there for those that are really wanting to save. They're wanting to prepare for the what if scenario. They have excess cash flow they can part with for 12 months. When all those things are true, then this is absolutely something business owners can look at.
Yeah, I mean, being in the industry now, I've come across a number of clients who've evaluated, and some for the right reasons, certainly some for the wrong.
Yeah.
The wrong side because a lot of folks are presented this stuff as a tax strategy, and a tax
Hmm.
strategy only because you put money in and grows tax deferred, you get favorable tax treatment on the backside. You know, Sounds great all in practice, but you got to be doing it for the right reasons, and that's why we partner with firms like Captive Consultants. So if you guys have any questions in the future as to how this may fit into your planning, please, reach out to me, and we'll coordinate an introduction with Clay and his team. I think they're an excellent resource for evaluating these type of plans. So with that, Clay, thank you so much for joining us and giving us some education on how these complex structures work.
Absolutely. Thanks for the time, and we'll look forward to chatting with you and your clients.
Appreciate you. Have a great day.
You too.